Hello and welcome to ACCA Practice to Pass webinars for March 2022 exam session. I hope you are doing well and your preparation is also going great. It's our day 4 for ATX Practice to Pass exam session for March 22. First of all, let me guide you over today's agenda. That is basically day 4 of ATX P2P session, and we are going to do 2 new practice questions, and one of them is practice exam 3 question 1, means it will be a 35 marks question, and the other one is of exam question March June 21, and it's question 3 means it will be a 20 marks question. Before starting the questions and the relevant things, as you are preparing yourselves for ATX exam, please do add 2 to 3 things while you are preparing for exam. What are those key areas? Few tips like the planning before start answering the questions. That is very important to pass your exam. Let's say as we are going to do a practice question of 35 marks today. So words are the prerequisites at time of reading the question and the scenario. As also discussed in previous session, first of all, read the requirements, and then by keeping that requirement in mind, then start reading the scenario. And while reading the scenario, try to pick up the relevant points to write in your answer. It would be saving your time actually. How it gonna save your time? Because let's say if any of you start reading scenario first and then comes to requirement, he will be again opening the scenario for reading the things for relevant points again. So you would be taking time twice. And for this question number 1, with respect to the format, report format and the memorandum, with respect to all these things, all these have already been discussed in day 1 of ATX session. So what we are going to do now, it's actually this question basically pertains to the tax planning thing, that which option is favorable, which option person should go for, what will be the relevant amounts and the liabilities under each of the alternatives. So it's basically question 1, and here is journal information is given with respect to this scenario, and you should assume that today's date is 8 June 21. By the way, please don't worry, I would be guiding you the relevant things, the relevant areas while reading this question. So we would be applying the knowledge gained while reading this question, and we shall be applying that knowledge while writing the answer. Your manager has had a meeting with Maya, a client of your firm. Extracts from the memorandum prepared by your manager following the meeting and an email from her detailing the work she requires to do are set out in the exhibits. The following exhibits. Number 1, an extract from the memorandum prepared by your manager dated 7th June 21. That's the memorandum of extract. And another extract from an email from your manager dated 8th June. Email extract. This information should be used to answer the question requirements within your chosen response options. What does it mean? If you want to respond using word processor, go for it. Either you have choice, you can use word processor or spreadsheets. Now it's depend on the question requirement that which option would be better to use while answering that specific part of the question. What are the requirements first? So you can see there are basically two requirements, A and B, and further the part B is further divided into three subcategories. Prepare the memorandum as requested in the email from your manager. The following marks are available. As we know that there are professional marks are available for this question, and for these professional 4 marks can be gained by writing in the memorandum form as required by your manager in a proper format, report format thing. And in that report, prepare requirement A, Josh, additional cash requirement for 9 marks. B, providing financial assistance to Josh, and there are 3 alternative strategies. What are those strategies? How the financial assistance can be provided to Josh? There could be a gift of investment property. We don't know the things we would be doing in this part of the question, but requirement is of 12 marks, which shows there are multiple things to do for this part of the question. Second strategy, gift of shares in FAR Limited for 7 marks and monthly cash gifts 3 marks. Now we have 2 other extracts like memorandum and email extract. I'm opening all of the windows and would be considering the important areas with respect to this question. Now, as we know the requirements, that first of all, we have to find the additional cash for Josh. And under B, there are 3 alternative strategies. The gift of investment property, or the gift of shares in FAR Limited, and number 3rd, the monthly cash gifts to Josh. And here is a background of this scenario. Maya is 63 years old and has significant personal wealth. She has taxable income approximately of 120,000 each year, which tells about that Maya is a high rate taxpayer, much of which she is able to save. She uses her inheritance tax annual exemption each year. Means if there would be any IST arising, so that annual exemption would not be available, and sold a residential investment property raising a chargeable gain of 15,000 in May 21. She is resident and domiciled in UK. Maya has agreed to provide financial assistance to her nephew Josh. Josh financial position. Jay recently left university, and on 6 April 21, the start of the fiscal year 21-22, the start date of the fiscal year 21-22. For this fiscal year, he started working for NL Limited, an unquoted company. Okay, means he would be getting the employment income. So while reading the question, you have to sum up your few points with respect to the scenario in your mind. It's not like that you are just reading you are just doing a plain reading. It should not be like that. While reading the question, few points you have to sum up, and there should be a roadmap that how we would be answering this part of the question. He earns annual gross salary of 25,200. All right. Since 6 April 2021, NL Limited has provided with the use of mobile telephone. When he joined company, since that date, company provided a mobile phone, and we know that whatsoever is the market value, there would be no taxable benefit in respect of this mobile phone, because one mobile phone is exempt. If two mobile phones are provided, one is exempt and on other one, a taxable benefit would be calculated at 20% under asset usage benefit. And also provided a home cinema system at the market value of 1700. Obviously, for this asset, we would be like under employment income for Josh, we would be taking an asset usage benefit on home cinema system at 20% of the value of the asset. On 1st June 21, NL Limited issued 200 ordinary shares to Josh. These shares, this share issue was not as part of tax advantaged approved scheme. It means these shares are of tax unadvantageous scheme. So any shares which are tax unadvantageous means the benefit would be arising and that benefit will be added to the employment income of the employee. Josh only paid 300 for these shares which had a market value of 2100 at that time. You can see that on the market value, but only 300 paid in consideration. So it means there would be a 1800 benefit which will be added to the employment income for Josh for the fiscal year 21-22. These shares are not readily convertible asset and Josh is not permitted to sell them until 1st April 25. Means any gain would any benefit would be taxed in the fiscal year in which these shares received by Josh. Josh currently receives dividend income of 420 each year. He is resident and domiciled in UK, which confirms that any UK income or worldwide income would be taxed in UK because Josh is UK resident as well as UK domiciled. Josh estimates that from 6 April 21 he needs 2500 per month to pay his rent and living expenses. So that is why in part A it is required that how much additional cash requirement for Josh, because he requires 2500 per month to pay his rent and other living expenses. For sure he would not be having much income from employment and this dividend source, so there is a shortage of funds. Now Maya has asked us to calculate how much cash J will need for the tax year 21, 22 and 22 and 23. Means for both of the fiscal years, first of all, we would be calculating the income tax liability, and obviously there would be NIC which is payable by the person, by the employer, that is cash, that is on gross cash earning, and employee pay class 1 NIC on the gross cash earnings. Then after paying the income tax liability and any NICs, the remaining cash will be calculated and that remaining cash will be compared with the 2500 per month into 12 months, which results in 30,000. So there will be a shortage of cash and Maya has asked us to calculate how much cash J will need for the tax year 21-22 and 22-23 over and above his post-tax income from all sources. Basically, he has two sources of income, the employment and dividend for both years. By the way, now we can actually start answering the first part of the question. So any question, any query which comes to your mind, I'm looking towards the chat box. You can ask your question before attempting this part A of the question. Yes, my dears. All right, let me guide you over this. As you can see, he has employment income in the fiscal year 21-22, so same things would be used for the next year because no other data is given for next year. So we would be assuming the same income is also available in the next fiscal year. And the other half of the question pertains to the part B1, B2 and B3. It's about 3 different strategies. And before answering this question, what is required with respect to part A, what is required by our manager, Josh, additional cash requirement. Calculate the total additional cash required by J over and above his income from all sources for the tax year 21-22 and the next year after deducting tax and NICs. In order to prepare the calculations efficiently, you should think about how Josh taxable income in next year will differ from that in 21-22. There is no need to provide any narrative explanation of your calculation. Very important point. There is no need to give narrative of your calculations. So it means it's this part of the question purely pertains to the calculation aspect. So I'm going to open a spreadsheet, and using this spreadsheet we have to prepare. So by reading the questions requirement, what you have planned actually, think more and write less. According to this strategy, we know one thing, that we are going to calculate for Josh additional cash requirement, but this cash requirement will pertains to 2 fiscal years. For the first fiscal year, we know one thing, that employment income is a part of non-savings column. Then there is a dividend column, and then the total of these both income. Skipping a column, then we should know about the cash position as well. So these are the relevant headings for answering the part of the question. Salary for the year is simply given in question, that is 25,200. Then when he started job, he got one mobile phone, that is exempt, nothing to do with it. If second mobile is also given, then on second mobile, asset usage benefit will be calculated at 20% of the value of the asset. Another thing is cinema system, and asset usage would be calculated on the value provided. 1700 was of market value once the asset provided into 20%. Resultingly, taxable benefit is calculated as 340. Then share options, but importantly, these shares options are an approved scheme. So for an approved scheme, from the market value of share, deduct the consideration paid of 300. Resultingly, 1800 is the benefit calculated. No other income is given. We can take the sum as employment income. To add all these values is equal sum, select the relevant cells, and 27,340 is an employment income. Then in each of the year, he is also getting dividend of 420, reporting dividend in its cost relevant column. So same, both figures would also be added to the total column. This income is total income as well as the net income. Why? Because no qualifying interest is given in question. So same amounts would be considered over here. In the absence of qualifying interest, the same amount would be considered as net income. and total net income is 27760. Then deducting the amount of personal allowance from the first column first and from the total as well. After deducting, taxable income is calculated. One figure is positive, other one is negative. So using the formula of sum, 14840 is the column for first non-saving, and dividend income, there is no amount, same amount can be considered over here, and using the same function for total taxable income. Highlight the important values, important cell values. Then for the calculation of income tax liability, on first column, this income would be taxed at a basic rate because person's total taxable income is 15260, which is less than the first band limit of 37,500. So resultingly, what we can do is that for first column income, we can multiply this value at a rate of 20%, and dividend income, for dividend income there would be no income tax liability. If you remember, dividend of 420 covered by the dividend exemption of 2000. The first 2000 of dividend income is exempt. So if total dividend income is 420, no tax liability on such dividend. So resultingly, total tax liability is calculated as the sum of these two values, 2968. Also doing the cash column as well, because we are working for additional cash required. So first of all, we should know about the actual cash position. From the employment income, he is getting 25,200 in the form of cash. From the dividend, he is getting 420 in the form of cash. It's a separate column just to know about the cash position of the person. And from these values, there is a liability as well, and this amount would be reducing the cash available. Furthermore, if a person actually having employment income on such amount, class 1 employee NIC is also calculated apart from liabilities. So class 1 employee NIC is calculated as from the gross cash earning, which is only 25,200. From the gross cash earning, that is 25,200, we know for first 9,500 pounds there is no NIC, and the differential would be multiplied with the 12%. So this is how you have to show the working in exam. It's not like that you are using your physical calculator and just placing the values. Examiner, if you read examiner reports, it is clearly mentioned that how you calculated the figures. So you should use formulas for presenting your answer, that how a value is calculated. Besides income tax liability, this NIC is also payable. So I'm going to show it as a negative figure, and is equal minus, and then selecting this cell is simply means you are giving the reference. Now what's the relevant heading over here? Cash available after income tax liability and NIC payments, taking the sum of the cash column from start till end. So he is only having 20768, the cash amount after paying all the relevant liabilities and NICs. But it is mentioned that income required for living purposes. And what's that amount? The relevant amount is 2,500 per month for whole of the tax year into 12 months. So cash required is 30,000. But after paying liabilities, he is only having 20768. And if 30,000 is required, so what is the shortage in this first fiscal year? Additional cash required for the fiscal year 21-22. The difference of these two values is equal sum bracket start, that is 9232 is the shortage of cash for the first fiscal year. As the manager has asked to perform calculations for 2 years, and while doing the working for next year, only consider that what will be the change to our answer. Work smartly and think what will be missing in the next year from all of the above calculation. 20 seconds. Think what will be missing in the next year. This amount would not be available in the next year. No. Cinema system is given, so the relevant benefit would also be calculated for next year. We are talking about share options. These share options would be a taxable benefit in a fiscal year in which these received. So these share option received in the fiscal year 21-22, so this amount will be missed out in the next year. Resultingly, if we start performing calculation for next year, we do not have to prepare all of the workings again, because for 22-23, as we are doing the work smartly, normal cash as per 21-22, taking the same figure, what was the normal cash available for previous fiscal year? That was 20768. After paying income tax liability and NICs, same amount would be available in next year, but there would be no share option benefit of 1800 in 22 and 23. Hence, income tax liability would be safe. If income tax liability is gonna save by 1800, if this amount is not in the next year, so what will happen then? It means on 1800 a liability at 20% will be saved, means additional cash. Now total cash in 22 and 23, by adding these two figures, we just added back the income tax liability save in absence of share option benefit in the next year, and income required for living purposes, Control C and Control V. Additional cash required, save your time, do not write again and again, just mark a change wherever it is required. Now from 21128, 30,000 is required. What is the shortage of cash? That is 8872. Concluding the part A requirement, that is total additional cash for both years. And going to take the sum of two figures. Here is the shortage plus in 22-23. So For both years, additional cash required is 18104. Hopefully you got all of the points. If still there is any unclarity, you may please ask. I would really appreciate your active participation in the session. Okay. This part was of 9 marks, and if you work smartly, you can easily gain. Okay, let me answer your question. Is the cinema given yearly or is a one-time thing? It's given for use. So if any asset is given to employee for use, so asset usage benefit calculated till the time the employee is using the asset. It's not mentioned in question that employer is getting back that cinema. So we have to calculate the same benefit of the asset usage in the next year as well, till the time the employer return the asset to employer or purchase from employer. Then on purchase or gift situation, there are two other benefits: asset gift benefit or asset purchase benefit. Share option income, these shares are granted to employer and he would not be selling these shares as clearly mentioned over here. He would not be selling these shares. So if he's not selling these shares, so there will be no income from these shares. All right. So this is how we attempted the part A of the question. Now let's move towards the other half of the question. What's in part B? I just opened the email extract from manager. Read it very carefully. Providing financial assistance to Josh, alternative strategies. As you can see, J has shortage of funds, shortage of cash for 2 years, and the total amount is 18,104. So in respect of each of 3 alternative strategies set out in my memorandum explain. By the way, first of all, read this thing and then read the email extract. I'm opening both. Maya is considering 3 alternative strategies to provide financial assistance to Josh. Number 1, gift of investment property. The relevant date is very important. 1st July 21. Fiscal year started on April 21, 6 April, but April, May and June, after 3 months from the 4th month, the gift of investment property. This investment property is currently worth 370. Maya purchased a property for 130 on 1st July 10. Since its acquisition, this property has been rented out for taxable rental income of 1100 per month. It is a residential building, but I don't know whether or not it has been rented out as a furnished holiday accommodation. By having these statements, it means now there could be a possibility that our manager would be asking that what will happen if this property is qualified as FHL property, and if this property not qualified for FHL property. And we know one thing, that for capital gain purposes, FHL property would be considered as a business asset. And on the disposal, transfer or sale of business assets, multiple type of reliefs are there. But manager is saying that, but I don't know whether or not it has been rented out as a furnished holiday accommodation or not. Under this strategy, J would continue to rent out the property on the same basis from 1st July 21 onwards, as we are working for 2 years, and 2 years are 21-22 and 22-23. So it means from this date, J will start getting the rental income of 1100 per month. From this to the next fiscal year end date, so there is a time period in total of 21 months, because from July till 31st March 22, and thereafter from 6th April 22 to 5th April 23, so total time period is of 21 months. Keep remember this thing. Second, to help J with the shortage of funds, as he is of shortage of funds 18104, his aunt actually providing financial assistance to Josh under 3 alternative strategies. What's the second strategy? Shares, gift of shares in FAR Limited on the same date. These shares are worth for 20,000. They represent the whole of Maya's shareholding in the company and constitute 14% of the company's issued share capital. Maya's father gave the shares to Maya on 1st May 20. You can see Maya got these shares on 1st May 20, and if he gives these shares on 1st July 20, the holding period is in fact less than, it's around 1 year time, but it's less than 2 years time, because for claiming any business property relief or for any business asset disposal relief, there is a requirement that ownership period should be of at least 2 years before disposal. Maya's father gave the shares to Maya on 1st April 20 when they were worth 375,000. The gift resulted in a chargeable gain of 225,000, of which 140,000 was held over via a gift relief claim. Under capital gains, we know one thing, that at time of disposal we should deduct the base cost of the asset. These shares transferred at a market value to Maya, and now Maya is transferring, giving these shares to nephew. So base cost will be deducted from the disposal proceed. And importantly, any transaction between connected persons is always like recorded at market value. Even though it's a gift, but still the disposal of these shares would be recorded at a market value. FAR Limited is an unquoted trading company. It owns chargeable non-business assets, which represents 16% of total chargeable assets. Unquoted company shares are always considered as business assets. If you remember the things from unquoted company shares are always treated as business assets, and on the disposal of business asset, a relief can be claimed to the extent of the business assets. And here you can see 16% are the non-business assets. So it means if there is any rollover relief, that can be claimed up to 84% of the gains amount, because there would be no relief available on the non-business assets. Furthermore, third strategy, monthly cash gifts commencing on 1st July 21. Mayas would simply make a cash gift of Josh of 1,000 each month commencing from 1st July 21 until 31st March 23. There are total number of months which are 21 months. It means in this strategy he would be getting 21,000 additional cash and would be meeting his living purposes. Now, let's read from here. As we have discussed the relevant strategies and the implication, now what our examiner is asking to us, what are the requirements basically? Providing financial assistance to J, alternative strategies. In respect of each of three alternative strategies, we have to do all these things under each strategy. Explain the increase in J's post-tax income for the 21-month period ending 5th April 23. You should only consider the post-tax income to be received by J in relation to the strategy 1 and 3, and no need to calculate additional cash under second strategy where he is getting shares of FAR Limited. For other two strategies, for first and third, you should only consider the post-tax income under these two strategies, first and third, and no need to calculate post-tax income under strategy 2. There is no need to consider the capital values of any of these strategies, as in the short term J will not realize any of this value. It simply means we would not be calculating any CGT implications. We would not be discussing any CGT implication for J because he is not going to dispose any of the asset. Then the capital gain tax liabilities for Maya only. It is also cleared over here that no need to calculate any CGT for J because he is not going to dispose any asset. It means all of the capital gain tax liabilities will be calculated for Maya only on the assumption that those reliefs which are available will be claimed. All right. And one more important thing, as Maya is high rate taxpayer and also using annual exemption, where it is written over here, she uses her inheritance tax annual exemption each year and also having a chargeable gain of 15,000 in the fiscal year 21-22 because May 21 is falling in the fiscal year 21-22. So it means if there is already a chargeable gain, it would be covering the annual exemption amount. Next thing to do, the inheritance tax implication for both persons, for Maya and Josh, including consideration of the availability of business property relief. By the way, we have already discussed that BPR would not be available because the holding period of the shares in FAR Limited is less than 2 years time. So BPR would not be available for IST purposes. For Maya, as I noted in my memorandum, I do not know whether the investment property qualifies as FHL or not. You should explain the liabilities for both possibilities. It means while answering about this investment property, we would be assuming first that this property is FHL, and then if this property is not FHL. So we have to tell the tax implications under both assumptions. You should not provide a definition of the FHL. So what we have to do for part B? First of all, calculate the post-tax income for J under first and third strategy. Second, CGT implication for Maya only under all three strategies, and the IST implication for both persons under three strategies. So why we are discussing it? Because as per the requirements, if you mark your headings properly, it's gonna give you the full professional marks, because it's very important that how you are actually representing your answer. Now it's time to respond on the part B. But part B is further divided into three things: B1, B2 and B3. Providing financial assistance to Josh, alternative strategies. For this, gift of investment property. Calculate the post-tax income for J. CGT implication for Maya and IST implication for both persons. For this, B2, no need to calculate after tax income for J. Do explain the CGT implication for Maya as well as IST implication for both Maya and J. And the third, we would be taking the post-tax income for J, then capital gain tax implication for Maya, who is transferring asset, and the IST implications for both persons, the Maya and Josh. Hopefully you are clear with the things that what we are actually going to do now. So it's time to start the answering of this question. Gift of investment property to Josh. What will be the other heading in the part B1? What we have to do now, income tax liability implications for Josh and post-tax income. After this, I'm just marking the headings, then I can move my heading to other cells. Capital gain tax implications for Maya only. And under B1, another thing, IST implications for both Maya and Josh. As you are asking that when the words in this cell get hidden, how we can make them visible? Simply you can use the arrows from the column above. So this is how you can write more if any words are hidden. So you can move from top of the column as I'm doing right now. Furthermore, let me mark the headings first according to the answer planning. Under part B2, what will we do over here? Under part B2, there is a gift of shares to Josh, and these shares are of par limited. Under this, no need to calculate the income tax implication for J and post-tax income. So what is required in part B2 as per the guidance given by manager? Capital gain tax implications. I'm not writing the heading again. I'm just copy and pasting over here under strategy B2. And then IST implication for both persons. So these are the relevant headings for answering B2. Furthermore, we would be adding few rows over here. We would be like moving our heading to the next cell. But first of all, let me mark the headings first. Then under part B3, where monthly cash gifts to Josh, under this, again, the same headings are relevant as in B1, income tax implication for J and post-tax income, CGT implications for Maya, and income inheritance tax implication for both persons. So taking the same headings over here to save our time. So this is how, first of all, actually what we are doing now, we have planned our answer. Now we will start answering each part of the requirement. Hopefully you would be finding this strategy good, because it would gonna save your time, because first of all we have read the scenario and also read the email extract of our manager, and then we are going to start the work accordingly as required by the manager. Okay, now under B1, where his investment property is gifted to Josh, and it is also written that Josh would be getting any rental income from the investment property, and per month rent value was given as 1100. So in fact, okay, let's start answering this part. Josh will get rental income of 1100 per month, and in fact 13,200 1100 into 12 months time. This 13,200 would he will get in a full tax year. By the way, his current total income, as we calculated above, his current total income in each year is only 15,260. So if additional amount of 13,200 is added each year due to this rental receipt, so still the person status will remain same. Still Josh will be a basic rate taxpayer. Going to add the same point over here, J will get rental income of 1100 per month and 13,200 in a full tax year, such that he would continue to be a basic rate taxpayer. Why we have written this point? Because due to this further income, there will be no impact on the tax rates. In fact, it will not get changed, as he is getting this gift on 1st July 21 and 21 months post-tax income till what? Why we are considering 21 months? Because we are talking about 2 fiscal years, and if he received a gift on 1st July 21, so for 2 fiscal year ended will end on 5th April 23. Would be, what will be the income, post-tax income? By the way, very simple. If he is going to receive 1100 per month for a total period of 21 months, and a 20% income tax liability would be applied, because he is still be considered as a basic rate taxpayer. On the income received, if any tax paid at 20%, so the post-tax income would be calculated at okay, by the way, it's the amount of tax, right? If you want to know further about the post-tax income, so you can simply change the percentage over here. By the way, we should know about, as we are calculating the post-tax income, so from 100%, if 20% is tax deducted, so what will be the post-tax income? So the resulting figure is directly calculated as 18480. What we have done is that 1100 is the per month rental income for 21 months from 1st July till 5th April 23. It means any income would be taxed at 20%. So what will be the post-tax income? That is 80% amount. That is in fact 18480. And over here, as he had shortage of fund for 2 years, 18104, if we get this investment properties, so this would be covered by the additional income after paying all taxes. Now let's talk about capital gain tax implications for Maya. Yes, obviously you should opt this plan while Moses, as you are asking, is it advisable to adopt this answer plan in all cases? Yes, if you can, you should adopt this plan. Why? Because it's gonna save your time, it's gonna save your planning aspect for answering the question requirement. So if you do practice like this way, so it's gonna help you out during your live exam. So first of all, we read the scenario, the requirements by the manager, and then planned our answer. And first of all, we mark the headings. If there is such kind of questions, you can plan out in the same way. Now, the gift, as we are talking about gift of investment property and CGT implications for Maya, the gift of investment property would be recorded at market value of 370 and resultingly a gain of 240,000 would be calculated. Where from we got this 240? From 370 is the market value and he purchased this property for 130. So a differential of 240,000 is calculated. Now, very important points. As our manager don't know about whether this property is FHL or not, so he has asked us to answer in both manners. If property is FHL, what will happen? If property is not FHL property, then what will be the tax implications? And for CGT purposes, we know one thing, that if it's an FHL property, then it would be classified as business asset and gift relief would be available and therefore no CGT liability will arise for Maya. Now answering the same things, taking the things from here, Control C and Control V, and make the appropriate change. If it is not FHL property, it would not be classified as business asset. Taking the second point as same as over here, and gift relief would not be available. And if gift relief would not be available, what will happen then? In the absence of annual exemption, as already covered by another disposal in the same fiscal year 21-22, as given in this scenario, gain of 240,000 would be taxed at, it's a residential property. So the relevant CGT rate is 28%. Why? Because Maya is a high rate taxpayer. So for high rate taxpayer under CGT, there are two rates, 20% and 28%. 20% is for rest of the assets and 28% is only applicable at time of disposal a residential property. 28% giving rise a CGT liability of 67,200. By the way, 240,000 if multiplied with 28%, so it's going to give you a capital gain tax liability of 67,200. So these are the CGT implication for Maya under both assumption, if this property is FHL property or not. And now let's talk about IST implications for both persons, the Maya and Josh. But again, For IST implication, we should also be considering the same points over here, because IST implication will get changed if property is FHL or not. So writing this answer, since Maya owned this property for more than 2 years, you can look at the purchase and sale date, 2 years prior to disposal. Then the asset could qualify for 100% BPR, business property relief, because FHL property is a business property, so we can claim BPR. And these implications are for Maya, but what's there for Josh? Because under this part we have to discuss for both persons. It will be necessary for Josh to hold the property till the time of Maya's death. Why? In order to qualify this building as a business property. Under IST, we study this thing that if any property transferred in lifetime, and if that property is a business asset, so business property relief can be claimed. But for transferee, for the giftee, the requirement is that that person, the giftee, has to retain that asset till the death of transferor or gifter. If this property is not FHL property, what are the tax implications under IST for both persons? Since the transfer of property is not FHL, means not a business asset, it means, so it would be considered, as per IST, it would be considered as PET, potentially exempt transfer, and no IST at time of transfer in life, because PET is a potentially exempt transfer and there is no implication for Maya under IST at time of transfer. What will happen to Josh and with this asset if Maya is going to die within next 7 years after this transfer time? If Maya will die within 7 years after transfer, then the asset will become taxable at 40% of the death rate after deducting any nil rate band available, if any. We know one thing, that if any asset is becoming taxable at time of death, so that asset can be covered from the nil rate band of the death year if available. Furthermore, another relief, taper relief, could be available if Maya survives 3 to 4 years after transfer. If this asset is becoming taxable at time of death, still a taper relief would be covering the tax liability. When this taper relief is available, if the gifter survives, means if transferor dies after 3 to 4 years after the transfer time, and any IST calculated would be paid by Josh. So that's the formal answer of the first part. We talked about on the gift of investment property, the income tax liability implication for Josh only, and the post-tax income. Furthermore, the CGT implication for Maya, considering both assumption if the property is investment property or not. Sorry, if the property is FHL property or not. IST implication for both persons under both assumptions. Hopefully all of the things are clear. I'm looking towards the chat screen. If you have any questions, you may please ask, as we're done with part B1 as well, and discuss the implications for both of the persons under the first strategy. So if you always do this kind of planning, it's gonna help you out while answering the questions requirement. That is very important for attempting professional exams. All right, my dears. Next thing is about part B2, where the gift of shares to Josh of Far Limited, and over here no post-tax income for Josh and income tax liabilities implication is required for Josh. Simply calculate the capital gain tax implication for Maya and IST implications for both persons. So on the gift of shares to Josh, as you can see, these shares were transferred by Maya's father on 1st May 20, and these shares are of unquoted trading company. Unquoted trading companies shares are always treated as business asset. If these are business assets, but the ownership period, the holding time period condition is not met. So the transfer of the shares in Far Limited, even though they are of unquoted trading company shares, they are business assets, but still business asset disposal relief would not be available because not meeting the holding criteria, that is minimum 2 years prior to disposal. Okay. Now let's talk about CGT implications for Maya. Disposal proceed would be recorded, and disposal proceed within connected person is always recorded at market value. For 20,000 is given in scenario. Cost, the rollover relief which claimed at time of getting shares from father. Then base cost will be calculated, and this base cost will be deducted from the disposal proceed, and after that gains, these gain will be covered from gift relief but to the extent of the business portion. Then chargeable gains. What is the cost of these shares? That is 375, because Maya's father gave shares at a value of 375, and at the same time both persons claimed rollover relief of 140. So the same ROR is deducted from in the calculation of Maya's father, which is irrelevant for us, and the same rollover relief would be deducted by Maya at time of disposing these shares to Josh. So taking the figures from here and writing 375 is the cost. From this 140,000 claimed as rollover relief, and what is the base cost calculated, the sum of these two. It's typo error, that is 375,000 in fact. This base cost is to be deducted from disposal proceeds. So marking a negative sign in between is equal and sum. There is a negative sign we marked just to have this value as a negative figure. Then sum of the above two figures giving you a gains of from 420,000. If 235,000 is deducted, 185,000 is the gain amount. Gift relief, very very important to understand now. Over here in this scenario, it is written that non-business assets portion is 16%. So it means remaining 84% is pertaining to the business assets. So gift relief can be claimed to the extent of the business assets. So is equal this value multiplied with the remaining business asset percentage, 84%. So 155,400 is the gift relief claimed, and this relief would be deducted from the gains amount. So chargeable gains are calculated as 29,600. Further point with respect to this thing is that business asset disposal relief is not available to Maya because holding period is less than 2 years. Please mark the relevant dates. She got shares from on 1st November 20 and disposing the shares on 1st July 21. So that is why holding period is less than 2 years. So cannot claim as BADR. Furthermore, CGT would be calculated at 20% on the gains of 29,600, considering Maya is high rate taxpayer. Resultingly, a CGT liability would be calculated would be 5920. Where from we are getting this 5920? The gains amount of 29,600, the chargeable gains multiplied with the high rate of tax of CGT 20%. It's not residential property, these are shares, but as she is a high rate taxpayer, so high rate of CGT is applicable. So if 29,600 is multiplied with 20%, so it's going to give you a capital gain tax liability of 5920. So here we talked about the relevant points for CGT implications for Maya. First of all, we calculated the chargeable gains, then discussed that why BADR would not be available. Furthermore, how much tax is calculated and what's the relevant percentage. Now let's talk about the IST implications for both persons, for both Maya and Josh. Again, BPR, because even though unquoted company share are always treated as business asset, but still BPR would not be available on this business asset, and the business assets are now shares, the unquoted company shares. As why it would not be available? As Maya's holding period is less than 2 years. Furthermore, hence any IST liabilities would be the same as investment property, where we treated investment property not an FHL. Please Save your time. Now basically you have answered this question by referring the things with the other part of the question. By the way, if like as we are not considering this FHL property, we are not considering this property as FHL, so even it's not a business asset. So if the shares are, even they are business asset but holding period is less than 2 years, so BPR would not be available, and such this transfer of share would be considered as PAT, and there would be no IST. And if M will die within 7 years after transfer, these shares will become taxable at time of death, but temporarily would be available, and any IST liability would be calculated, would be paid by Josh. Rest of the things are the same, where we are considering FHL is not this property is not FHL. So if these shares are not qualifying for business assets, so any IST liabilities would be the same as investment property, where we treated investment property, not an FHL property. Hopefully this part of the question is cleared. Yes, if she actually let me answer, Gerald, you can, as you asked her, assuming if she had hold the shares for the stipulated period, so that she would be eligible for, yes, obviously, because unquoted company shares are always treated as business asset and also meeting the criteria of the holding period. So any disposal of the shares will also qualify for business asset disposal relief. Then irrespective of the status of taxpayer, we would be charging capital gain tax at 10% under business asset disposal relief. Yes, you are right. Etisham, yes, you are also right. It's a gift relief basically. Okay, because by the way, we can also use the word rollover, because any gains which are under gift relief, they are also actually rolled over for future time period. So nothing to worried about the term rollover or gift. Okay, moving forward, part B3, where the person would be giving 1,000 cash each month commencing from 1st July, and we are talking about remaining 21 months till the end of 5th March to 5th April 2023. So it means over here J would be getting 1,000 per month for 21 months. So what are the implications for Josh and after tax income? Furthermore, as we have already marked our headings, income tax implication for J and post-tax income on the monthly cash gift by his aunt, then Cgt implication for Maya, and IST implications for both on monthly cash gifts. Very easy, very, very easy. No income tax liability implications for Josh on receiving cash. Hence, over a period of 21 months, Josh would therefore receive 21,000. How? 1,000 each month for a total period of 21 months. So resultingly, he is getting 21,000 over a period of 21 months, and there are no income tax liability on the gift received each month. Capital gain tax implications for Maya. Cash is an exempt asset for CGT purposes. Hence, no CGT liability for Maya. IST implication for both person. Cash gifts are likely cash gifts are likely to exempt from IST. Why? Upon meeting the following conditions. If they meet the following condition, so the gift of this cash is also exempt from IST, means there would be no implication for both the persons. First condition, it would be the normal distribution out of Maya's income. Another condition, there would be a regular pattern of giving. Another thing, these cash payments would not affect Maya's living standard. So anything which you are giving, if that giving is not impacting your living standard, so it means there will be no IST implication for both of the persons. And furthermore, his cash requirement will be resolved as J require additional cash for both year 18108. Under strategy 1, he will get 18480 as in the form of rental income of investment property, and this was not needed under part B2 of when the shares were gifted, but it was required in part B where the Josh is getting cash. So this is how he would be resolving the shortage of cash of 18104. So that's the formal answer. You have to write your answer in exam this way. First of all, the normal heading, the main heading, then J, additional cash requirement we solved by preparing a proper format for 2 years, 22-21 and 21-22. Thereafter, we calculated the total cash shortage. Furthermore, under 3 alternative strategies, we also discussed the relevant implication for each person as it was required by our manager to explain the things in a proper manner. And now I'm looking towards the chat screen. If you have any query in your mind, you may please ask. No, my dear, you don't have to like select any strategy, because we are not actually, a question requirement is not about the selection of strategy, that which strategy is best for both and in which there are lower income tax and CGT liability. It's not like that. Our manager has asked us to provide the relevant implication under each strategies. So nothing to conclude that which one is the best strategy, how Maya should give financial assistance to Josh. By the way, the client is want to know about the tax implication under 3 alternatives actually. All right. Okay. So now you can see, if you do practice and if you plan your answer in such a manner, so you would be able to complete this 35-mark question in a timely manner with proper headings and the proper responses and responding to all of the requirements. So it's not gonna take too much time for answering these things. Furthermore, I would be sharing the proper answer of this long question, 35-mark question. I would be sharing the answer in the WhatsApp group. So in case if you wish to look at the calculation and the amounts, you may follow the Excel sheet that would be shared in the group. So then you can practice these types of questions at your own. All right. Now we can take a 10 to 12 minutes break, and after break we would be starting the other half, the other question for today's, that is exam question 3 March June 21 exam session. It's a section B type question. So I would be starting after 12 minutes. It's exam question 3 of March June 21 exam session. Welcome back. Till now, as we have covered the day 1 and day 2 session conducted by Sir Kambar Raza, and in yesterday's session we attempted these 2 exam questions, and in today's time we are done with the very first question of practice exam 3, that is question 1 of 35 marks. Now, as highlighted, we are going to attempt another exam question 3 of March June 21 exam session. Can you please confirm, am I audible to all of you, please? Can you please confirm this thing? And one more thing, that we both, Sir Kambar and I, designed and planned these 4 sessions in a manner so that all of the areas would be covered in respect of these questions by attempting these questions. Thank you for your quick responses. So now, before moving on towards the next question of March June 21, before that, quickly recall the relevant areas first, as these are tested in the exam question. By the way, the very first page pertains to the discussion we had while attempting question number 1. The first question for today, in which there are IST and CGT implications for Maya and Josh. So this slide will be helping you out, and it's a summary. So you should be using the knowledge from this summary while attempting the question, as we discussed all of these relevant points as we were doing the question. Now, on the next slide, there is a concept of closed company. As we are going to start another question, but before that, let's try to discuss few concepts which are tested in that exam question. My dears, closed company is a company which is controlled by 5 or less shareholders, or means condition 1 can be met or condition 2 can be met. If any of these condition is meeting, the company would be considered as a closed company. The first condition, any company which is controlled by 5 or less shareholders, and other condition, or all shareholders are directors. What does it mean? Let's say now we are assuming that there are like 15 shareholders, but if all of the 15 shareholders are also employee of that company, are directors of in such company, so still that company would be considered as a closed company. I repeat, any company which is controlled by 5 or less shareholders, or all of the shareholders are directors, means employee of the company. If any of these 2 condition is met, so the company would be the closed company. Basically, what are the implications for closed company? Keep remember, closed company concept is not applicable for quoted companies. Closed company concept is always there for unquoted companies, not for quoted companies. And shareholders should not be a corporate shareholder. What does it mean? Let's say here is a company. This company shareholder is Mr. A, fine. This shareholder is Mr. B, fine. This shareholder is Z Limited. This can never ever happen. For a closed company, all of the shareholders should be the individual person, not the corporate shareholder. Means this closed company, any company which is owned by any other company, that company would not be considered as a closed company. It means all of the directors should be the individual persons, not the corporate shareholder. As you can see, Z Limited is a company. So Z Limited, instead of the company, instead of any company, all of the shareholder could be the individual shareholders, not the corporate shareholder. So these are the prerequisites for considering a company as a closed company, which is controlled by 5 or less shareholders, or all of the shareholders are directors in that company. Closed company concept is only applicable for unquoted companies, and any of the shareholders should not be the corporate shareholder. Generally, and now let's talk about the implications with respect to the closed company, and importantly, the closed company concept and its implication is tested for like half of the marks in the exam question, which we are going to attempt now after this discussion. So very important from exam perspective. Generally and legally, shareholders are not allowed to take the company's things or assets. As normally for unincorporated businesses or for sole trader businesses, there is a concept of drawings is there, that owner can take cash, owner can take inventory from business for personal use. But normally these things are not there in a company situation where there is a incorporated business, means a company. Generally and legally, shareholders are not allowed to take the company's things or asset. But since, as you can see, that this company is actually owned by few shareholders, but since this company is a closed company with only few shareholders, so practically speaking, it's very difficult for management to say no to shareholders. Let's say, for example, there are only 3 shareholders of an unquoted company, and it means the company would be considered as a closed company. And now, as there are only 3 shareholders in our example, and if let's say any shareholder asks company to give a car for his own use, so basically there are only 3 investors are there, and one of the investor is asking for asset to be used for personal purposes. So at times, practically speaking, it's very difficult for the management to say no to shareholders. Why? Because there are only few shareholders in closed company, and company cannot deny their demands at times. So to deal with these situations, HMRC introduced some special rules as discussed in situation A and situation B as follows. Now, what is actually happening and what will be the tax treatment? Basically, from the closed company, shareholder would be taking any asset or any other loan and any other thing. So what will be the tax treatment? Because now company is now providing these things to the shareholders. So it's actually about the relationship of a shareholder with the company, and shareholder is taking assets or loan for personal use from the closed company. So at the same time, HMRC introduced some special rules as discussed in situation A and situation B as follows. What's in situation A and what's in situation B on the next slide. In situation A, if shareholder take the company's asset for personal use on a temporary or on a permanent basis, and in situation B, shareholder is taking out loan from the company for their personal use. So keep remember, for our easiness, we actually divided the situations into 2 scenarios, situation A and situation B. Situation A pertains where the shareholder is taking any assets from the company, and under situation B, shareholder is acquiring loan from the closed company for personal use. Then when a shareholder takes an asset for personal use from the closed company, that asset can be taken for on a temporary basis or on a permanent basis. Then before discussing the tax treatment, we should know about the type of shareholder. Now what exactly do we mean by this type of shareholder? Because basically the shareholder could only be the shareholder, or that shareholder could also be the employee or director in the closed company. The tax treatment will differ if the shareholder is only a shareholder, not an employee of closed company, and under A2 we are considering that can be shareholder plus the employee or director of the company. So tax treatment will differ if the shareholder status gets changed, either that shareholder is only shareholder or the shareholder or as well as employee in that company. So under situation A1, by the way, what exactly is A1? Where the shareholder is only a shareholder, that is A1, and where the shareholder is shareholder and employee or director, that is situation A2. Let's discuss one by one. So here are the implications for company and shareholder under situation A1 and as well as under situation A2. Keep remember, shareholder is taking an asset for personal use on a temporary or permanent basis. Shareholder can only be the shareholder then any benefits provided by company to shareholder. What are the implications for company and what are the implications for shareholder? For company, the cost of providing such benefit to the shareholder is disallowed expense. Normally, what the companies can do is that providing any benefits to employee can be deducted as an allowable expense from the trading income. But over here, that person is only a shareholder, not the employee of the company. So company cannot deduct the amount of that asset benefit from the trading income. That is disallowed. For shareholder, what are the implications for shareholder? At time of getting any asset, and shareholder is only a shareholder, not the employee. Any benefit calculated in accordance with the employment income rules. HMRC asks you to calculate the taxable benefit as normally we calculate under employment income at time of providing any asset, and we do calculate the asset usage benefit for employee. HMRC asks that please do calculate that amount, but after the calculation, when we get this amount, the benefits calculated under employment income rules would be taxed as dividend income for that shareholder, because that shareholder is now only a shareholder in that company, not the employee. So first of all, for calculation purposes, use the employment income rules for calculating any taxable benefit on that asset, and after calculation, take the benefit amount as dividend income for that shareholder. It means the dividend income rules and exemptions, all things will be applied for the shareholder. Now, under situation A2, where the shareholder is shareholder plus employee in the closed company, and over here, if any benefits provided to that shareholder plus employee, what are the implications for company? Now, company can deduct, it's a typo error now, where the person is director as well as the employee in that company. So the cost of providing such benefit to shareholder, which is also an employee, is allowed expense. Where the shareholder was only shareholder, in that scenario that was disallowed. Where the shareholder is shareholder and employee as well, that is allowed expense. These are the implications for company, but for employee, what are the implications? Benefits calculated in accordance with the employment income rules, the amount calculated over here at the asset usage at 20%, or the amount of the asset provided, it would be not on a 20% normal asset usage, it would be the amount of the asset provided given to the shareholder. And any benefit calculated under employment income rules would be taxed according to the employment income. Why? Because now that person is also an employee, so this benefit amount would be considered as employment income, and it would be treated as normal employment income, as we do record the employment income under non-saving column. Then for non-saving, rate of taxes are 20%, 40%, and the 45% after deducting annual personal allowance and all that. So here we discuss that treatment when the closed company is providing a company's asset to shareholder on a for personal use on a temporary or permanent basis. So we discuss the relevant treatment under both situations, when the person is only shareholder and when the person is shareholder as well as employee in that company. Let's move towards the second situation, situation B. Now in B, shareholder take out the loan from company for personal use. In this situation, ignore the employment status of shareholder with the company. As we discussed, at time when the company was providing asset, so first of all we checked that the person is only shareholder or shareholder plus employee. But when a closed company is providing loan to that shareholder, so without considering, ignore the employment status, whether that shareholder is only shareholder or shareholder plus employee in the company. Ignoring this thing, now let's talk about the implications for both company and shareholder under three different scenarios: at time of providing loan, at time of loan repayment from the shareholder to closed company, or let's say in case where the shareholder would not be repaying the amount of loan to closed company. So obviously then the closed company would be writing off the loan amount. So basically we are going to learn the tax implications for both the company and shareholder for three different times. First time is when the loan acquired by the closed company. Second time, if shareholder is repaying the loan amount to company. And number third, if shareholder is not repaying the amount of loan to company. So these three different times has different tax implications. Number one, at time of acquiring loan. Implications for company. Company has to pay a 32.5% of the loan amount to HMRC as well. Let's say 100,000 of loan provided to shareholder, and at the same time an amount of 32.5 means 32,500 the company would also be paying to HMRC. Why company is actually also paying this amount to HMRC? Because according to taxation rules, if HMRC says that if a closed company is providing loan to a shareholder, and that is why that company has also to make an additional amount of 32.5% to HMRC as a security deposit along with the corporation tax liability. So these are the implications for the company at time of providing loan to shareholder. Now, what are the implications for that shareholder who is acquiring loan from the closed company? No tax implication for shareholder at time of acquiring loan. All right. At time of loan repayment, now let's say shareholder is making repayment of loan to company. That repayment can be a complete repayment or a partial repayment. What are the implications for company, as now shareholder is giving back the amount, repaying the amount of loan? So at the same time, HMRC also refund the amount to the company at 32.5%. If whole amount of 100,000 repaid by the shareholder to company, so HMRC would also be giving back this 32,500, the whole amount, the complete amount to the company. But let's say from this 100,000, only 50% repaid by the shareholder to the company. On the same amount of 32,500, HMRC would also be repaying the same amount of at 50%. So company will get refund from HMRC at 32.5% of the loan repaid amount. If loan repaid in full, then this 32,500 company would be getting this whole amount of 32,500 from HMRC. But let's say shareholder is only making a repayment at 50% of the loan amount, so HMRC would also be giving a 50% refund from the 32,500. At time of repayment, no tax implication for shareholder. Number third, loan write-off. If complete or partial loan written off, then company will get refund. The closed company will get refund from HMRC at 32.5% of the loan written off amount. Let's say from 100,000 shareholder returned 50,000 and refused to pay further 50,000. So it means company is writing off the loan amount to the extent of 50,000. So at the same time, on the loan return off, HMRC would also be repaying an amount of at 32.5% to that closed company. But very importantly, as the shareholder is not repaying the amount of loan, so such thing would be considered as a dividend distribution. Why? Because the person is now shareholder acquired loan from company and not repaying the amount of loan. So it means as now company is writing off the amount of loan given to shareholder, so this amount would be considered as dividend income for that individual person and would be taxed according to the dividend income rules. So the first 2,000 is exempt, and any dividend income more than this 2,000 would be taxed at 7.5% or 32.5% or 38.1% according to the status of taxpayer status of the person. If a person is a basic rate taxpayer, he would be paying tax at 7.5%. If a person is high rate taxpayer, so the dividend rate in high rate is 32.5%. And if a person is additional rate taxpayer, means his total taxable income is more than the second band limit of 150,000. So any dividend falling in the additional rate band, on such dividend amount, a rate of 38.1% is applicable. Further things to note that the above discussed rules are not applicable if when which rules? All these rules would not be applicable upon meeting of three conditions. Upon meeting of three conditions, it's not like that any of the three conditions if met, so these rules will not apply. Keep remember, all three conditions should met. The principal amount of loan is less than 15,000, and means second one is also important to met. The individual is full-time employee and owns less than 5% shareholding. So if all these three conditions are met for and that shareholder is requiring loan, so nothing to do with respect to all these things, means if now company is providing any loan, so no need to pay additional 32.5% to HMRC and all that. Next thing, upon meeting of all three conditions, no need to pay an amount of 32.5% of loan to HMRC. As we discussed that normally at time of giving loan to shareholders, company has to make a payment at 32.5% of the loan amount to HMRC. Now the loan benefit. By the way, if any loan is provided to a normal employee, so what we do is that we calculate the loan benefit. So shareholder can be charged a lower interest as compared to the official rate of interest. And official rate of interest for our studying purposes in ATX is 2.25%. So when the closed company is providing loan to employee, on such loan interest would be charged. That interest could be charged as compared to official rate of interest. Company can give this loan to shareholder, let's say at 2%, at 1%, or at any agreed percent. It's not like company always would be making loan to that shareholder at official rate. It's not like that. The loan can be given to shareholder at a lower rate as compared to the official rate. Next point, if shareholder is only shareholder, not employee, then the amount of loan benefit calculated would be taxed under the dividend income rules. Why? Because the shareholder is now only a shareholder and he is getting a benefit from the company, and any benefit if received by a shareholder, so for that shareholder that benefit would be considered as dividend income, and the dividend income rules is applied on the amount calculated. But if the shareholder is a shareholder plus employee in that company, then obviously the loan benefit calculated would be taxed as per the rules of employment income, as well as class 1A employer NIC would be applicable. And by the way, for recalling purposes, class 1A NIC is paid by employer on the amount of net taxable benefits, on the amount of net taxable benefits. And class 1 NIC is paid by both but on gross cash earnings, and it is payable by both the employee as well as employer. But payment of class 1A NIC is only the responsibility of employer on net taxable benefits, whereas class 1 NIC is paid by both employee and employer on gross cash earnings amount. Another area tested in that exam question, which we are going to start after this discussion, that is the discussion of the capital gains for companies. What is a simple performer to follow while calculating any capital gains for a company? From take the disposal proceed, and from this disposal proceed deduct the cost of disposal. So the net disposal proceed would be calculated. Cost of disposal could be any of these, like carriage outward, selling commission. The seller is also doing advertisement and bearing advertisement expense and any legal charges, etc., for selling that asset. All these can be considered as cost of disposal. So from disposal proceed, we deduct cost of disposal, net disposal proceeds are calculated. Now, take the purchase cost, add the improvement, and add any indexation allowance. For companies, no concept of annual exemption. Instead of annual exemption, in companies, there is a concept of indexation allowance. So indexation allowance would be adding the overall cost. So if the cost is increasing, so resultingly capital gain will go down. For individual person, there is a concept of annual exemption which reduce the gains amount, but over here indexation allowance increase the cost. Ultimately lower gains are calculated. If lower the gains, lower the tax liability. So that's a basic difference between individual and company CGT calculation. Now let's talk about what is indexation allowance. By the passage of time, the assets prices and the things gets inflate. So indexation allowance is actually an adjustment for inflation, and it is calculated on the basis of RPIs. By the way, for normal economy purposes, there are CPIs, consumer price index. In normal economy, if we want to check inflation, so economists use CPIs, consumer price index. But for taxation purposes, if you want to monitor or measure inflation, so we use RPIs for such calculations. It is calculated on the basis of RPIs, which is used to measure or monitor inflation for taxation purposes, and RPIs, practically speaking, are issued on a monthly basis in UK, and for our exam perspective, it will be given in exam questions. So nothing to worry about RPIs. It would always be given in exam questions. Now, how we calculated this index cost? How we calculated this index cost? When we added indexation allowance to the other costs, so resultingly we got the indexed cost. So it is also written over here, index cost is calculated as cost plus indexation allowance. And for the calculation of indexation allowance, first of all, we require indexation factor multiplied with the expenditure amount. Expenditure amount simply means asset purchased cost. Expenditure amount simply means the asset purchase cost or any improvement cost or any enhancement cost, means any capital expenditure incurred. For the calculation of index allowance, what we actually require, the indexation factor multiplied with the expenditure amount, the purchase cost of asset. how this indexation factor is calculated. Indexation, for the calculation of indexation factor, simply take the RPI of the month of earlier of, deduct the RPI of the month of expenditure when this asset purchased, and divide it with the same RPI of the month of expenditure. So it would be giving you an indexation factor, and according to tax laws, this indexation factor must be rounded off. It's not round up, it's not round down. By the way, we use round down at time of calculating the car benefit CO2 emission percentage. There is a rule, we have to round down, but there could be round up. But specifically for indexation factor, this indexation factor must be rounded off. According to normal mathematics rule, we would be rounding it off to 3 decimal places. It must be rounded off to 3 decimal places. Okay, one thing is left over here, the month of earlier of. Earlier of means any RPI from these 2 dates would be considered over here. Let me guide you further things with respect to earlier of disposal month or 31st December 17. Why we are comparing, why we are actually in comparison, why we have this 31st December 17, why we have this specific date. Because after 31st December 17, indexation allowance concept is discontinued. So very importantly, if any asset, please mark my words, if any asset which purchased before 31st December 17 and now we are disposing that asset, on the disposal of such asset which purchased before 31st December 17, at time of disposal of such asset we would be calculating indexation allowance. But if any asset which purchased after this date, 31st December 17, if any asset acquired after this date and now we are disposing that asset, we would not be taking indexation allowance on the disposal of such asset. Why? Because any expenditure incurred after 31st December 17 would not get any indexation allowance, because this indexation allowance concept is eliminated practically in UK from 31st December 17. So if any asset acquired before 31st December 17, on the disposal of that asset we would be considering the indexation allowance as well. But if any asset which purchased after this date, 31st December 17, on the disposal of that asset we would not be taking indexation allowance in the calculation. And furthermore, if number of expenditure incurred, like first of all you purchased an asset and thereafter you incurred some improvements, it means now, and all these things are should be before 31st December 17. So that is why you would be taking indexation allowances. So number of indexation allowances would be considered. For example, purchase date, you incurred a cost for buying an asset on 1st April 10, but subsequently you improve that asset on 1st May 19. So we would be only taking indexation allowance for cost and no indexation allowance for improvement, because this improvement being incurred after 31st December 17, whereas we purchased the asset on 1st April 10 before 31st December 17. For example, let's change the date. If after acquiring this asset after 2 to 3 years on 1st May 13, you incurred some improvement, you enhanced the asset, you constructed, you extended the factory area, so it means you incurred expense before 31st December 17, so indexation allowance would also be calculated for this improvement thing as well. Is this thing clear? Last point, good enough to know that you guys are very clear. Okay, but keep all these points in mind, because we are not just discussing, We have to follow, we have to apply, we have to use all of these things while answering our next exam question. Indexation allowance can reduce the gains amount to nil but cannot create a loss or cannot create a negative figure. What does it mean? As normally we know that personal allowance can reduce our taxable income, annual exemption can reduce the gains amount, but annual exemption, the personal allowance, the indexation allowance, and any other allowance or relief can reduce the amounts of income or gains, but they can never ever be creating a loss amount. Due to these things, loss can never ever be created. Okay, now we have discussed the relevant points from the PDF, and it's time to start the other question, that is exam question 3 of March June 21 exam session. It's March June 21 exam question 3. As we are going to attempt third question, so from navigator I'm directly moving towards the question 3. And it is purely based on the discussion we just had from the PDF file. Again, we would not be reading this question. However, we would be reading by planning this question, that how to answer. Yes, very right, Gary. As you are asking, if any expenditure like 2 3, let's say first of all we purchase an asset in 2010, then we improved that asset in 2011, then subsequently in 2013, then subsequently in 2015, now we improve that asset in multiple years. So it means we would be calculating multiple indexation allowances, first of all for the cost which incurred before 31st December 17, and then the first improvement in 2011, we would be taking indexation allowance on such improvement as well. Then any improvement being made in 2013, we would be considering indexation allowance for that improvement as well. Very right, you are as you are asking. So it will gonna happen that if you incurred any improvement before 31st December 17, and it will not be like, let me show you from here, we have written that number of expenditures incurred before 31st December 17, so number of indexation allowances would be calculated. Okay, let's start this question. You should assume that today's date is 1st March 22. S Limited requires advice on the cost of gifting a computer or alternatively making a loan to one of its shareholders. Now you can see company S Limited is providing gift or loan to its shareholders. So it's a concept of closed company, and the implication will be the same as we just discussed over here. If a computer is gifted, so it will impact the benefits amount, and over here a loan is provided, so it's according to situation A as well as situation B. We have to consider all of the things with respect to each situation discussed over here. As shareholder is taking a loan from closed company, in situation A shareholder is taking an asset from the company. It's all about the first company, S Limited. What next is there for K Limited? K Limited has requested advice on the tax implications on the following exhibit. Available on the left hand side on the screen, provides information relevant to the question. Sorry. K Limited has requested advice on the tax implication on replacing a factory and acquiring a new factory. It's about second company. As you can see that it's in general information, it is written that K Limited, Calp Limited is disposing a factory. Factory is normally a business asset, and acquiring a warehouse. Warehouse is also could also be a business asset. And very clearly we know one thing, that an individual person as well as a company both can deduct the reliefs at time of when they dispose business asset and acquire a new business asset. But further things depend how they invest, how much they invest, whether they are making the full reinvestment or whether they are making a partial reinvestments. It's these are other points which we would be considering while reading this scenario. Now we are clear with the things. For S Limited, we have to do the things according to the closed company concept, and for K Limited, we have to keep in mind the things with respect to rollover relief or the holdover relief and all that, and the partial reinvestment or the complete reinvestment. Now, requirements of the question. After these requirements, I will open this. I will be covering the things, the reading from the relevant exhibit. You should assume that today's date is 1st March 22. Explain with supporting calculation. Explain. Also show the calculation. The total additional tax payable by S Limited. If S Limited give the computer to Nuri, that's the alternative one. And if S Limited makes a loan of 1500, instead of providing this asset, if company is providing a loan to shareholder, and then writes off the loan. Now you can see it's from here. Company would be writing off the loan amount, right? But on the loan amount, it would be considered as gross cash earning, because now employee is getting cash from the company. If the shareholder is also employee, then it would be a gross cash earning. But if the person is only a shareholder, then it would be considered as dividend income for that employee at time of writing of the loan amount. But if the person is shareholder and employee, then the class 1 NIC on gross cash earning would be calculated. Back to the scenario. If S Limited makes a loan of 1500 to Nori and then writes off the loan amount on 6 April 24, and it's alternative 2. Note, ignore any value added tax for the first 10 marks of the part A. Before reading the scenario, let's decide the roadmap. That what should we do in this question for answering? What should we do is that we are going to answer the part A of the question, and in part A it is required that total additional taxes payable by S Limited. So that's the main heading. Under A1, marking the subheading alternative 1, gift of computer to N, make it highlight. Under A2, alternative 2, loan to Nore. Obviously we would be like changing for spacing purposes, we would be like transferring this heading from one cell to another cell. But this is how, first of all, you would be deciding that what you are going to do for answering this part of question. Now, as we have decided that what should we be doing, let's read this scenario very carefully. Let's read this scenario very carefully. It's about the person. N owns 75% of the shares in S Limited. Okay, more than 5% shareholding. has been a director of in the same company for many years. Now from here we have decided the person is not only a shareholder, the person is also an employee in the same company and owns the and also owns the whole of the ordinary shares in Calp Limited. It's also another relation between Nori and another company, that is Calp Limited. But as we are going to discuss about the implication for S Limited and between his shareholder and its shareholder, so ignoring this part of question, but for the time being we have read this statement that N also owns the 100% share capital of K Limited as well. Now let's talk about S Limited. S Limited is a UK resident closed trading company, which prepares accounts to 31st March annually. Will either gift a computer to Nori on 6 April 22 at the start of the fiscal year 22-23, or alternative 2, make a loan to N on the same date to allow him to purchase a computer. Now company is actually would be doing any of these two things. Either the company would be providing a computer directly to shareholder, or that shareholder is not only a shareholder as well as employee of that company, or company would be providing a loan of 1500 to Nori to allow him to purchase a computer himself. Under alternative 1, S Limited gifts of computer to Nori. The computer was purchased by S Limited in March 21 for 2600 and has a current value of 1500. Over here you can see that in alternative 2, company would be providing a loan, and in alternative 1, company would be giving an asset to the market value of 1500 to the shareholder plus employee of the company. S Limited has purchased no other plant and machinery for several years, and the written down values of its main pool on 6 April 22 will be nil. Okay. The sale proceeds for the purpose of capital allowances will be nil. All right. Nori private use of the computer has been significant throughout S Limited's period of ownership. Okay. Under alternative 2, closed company makes a loan to shareholder and employee on 6 April 22 on the same date when it would be providing asset to employee. On the same date, under alternative 2, on 6 April 22, S Limited will make an interest-free loan. As we just discussed over here, that interest can be given to the person at a lower rate as compared to the official rate. Now it is evident from here, company is making an interest-free loan, means not charging any of the tax, not charging an interest from Nuri, and loan amount is 1500. Over here company was providing an asset with the market value 1500. In alternative 2, company is providing 1500 to that shareholder, and that person can purchase the computer him or herself. S Limited will write off the loan on 6 April 24. All right. So it's all this information pertaining to the part A of the question. So we would be coming back and we'll read and we'll answer the part B of the question as well. But let's talk about alternative A1, where the closed company is providing an asset to the shareholder plus shareholder come employee of the company. What are the implications for both the person and the company? But basically what we are going to do is that we have to calculate total additional taxes payable by S Limited under both alternatives. It's very interesting. N is employee and shareholder of S Limited, which is a closed company. Therefore, providing from here shareholder plus employee, for company it will be an allowable expense, and for shareholder it would be considered as employment income. But as it's interest-free loan, remember this thing in mind. Therefore, providing computer to N will result in taxable benefit of 1500 for N. So these are the implications for person. Now let's talk about company. S Limited has to pay class 1 NIC, which is payable on the benefits provided to employee. S Limited has to pay class 1 ANIC, class 1 ANIC on providing such benefit, and NIC liability is simply 207. How we calculated 207? The value of the asset provided multiplied with the class 1A NIC percentage on net taxable benefit. Employer always pay NIC at 13.8%. So 1500 into 13.8% is gonna give rise class 1A NIC liability of 207. By the way, as we know that NIC, adding other point as well, NIC is allowable deduction for company. So increase in expense would be reducing corporation tax liability by 39 only. How? Because if company is deducting now 207, the NIC paid on the benefit amount, so that's an allowable expense. If this amount of 207 is increasing the expenses amount, so it means corporation tax liability will go down by 19%. So NIC would be deducted. NIC is allowable deduction for S Limited, so increasing in expense would be reducing corporation tax liability by 39. How? 19% into the amount of expense. Therefore, the total amount, the total additional tax payable by S Limited in respect of this alternative is 168. Why? Because from 207 is the total cost, but this cost would also be resulting in a corporation tax liability saving at 39. So on one hand, company is bearing 207 as an expense, but on claiming such expense, if 39 is deducted by reducing that's a reduction in the corporation tax liability. So resultingly, the total tax payable by S Limited would be 168 under alternative 1. What next is there? Let's talk about the second alternative, that is provision of loan to the shareholder who is also an employee. So basically, we have implication at 3 different times: at time of providing loan, at time of writing off, because employee is not repaying any amount, so skipping this one part, and we have to discuss, we have to tell two things: what are the implications for company and person at time of acquiring loan and then writing off loan. So I'm just marking a heading at time of providing loan. That's the first thing to discuss. And another thing, write off loan amount. That's the second thing to discuss under this part of the question. Providing loan of 1500 to Nuri will not result in any taxable benefit for Nuri because no tax implication for person at time of taking loan. Another thing we study in employment income that if the loan amount is less than 10,000, then straightforward there that loan benefit is exempt from taxation. In employment, we normally study about loan is that on providing of loan under employment income, loan benefit is calculated according to the accurate method and the average method, but loan benefit is exempt if the amount of loan is less than 10,000. So adding the same point over here, providing loan of only 1500 to Nuri will not result in any taxable for Nuri as the loan amount is less than 10,000. But next is there, in the absence of any taxable benefit, S Limited would not also be paying any class 1A NIC because class 1A NIC is always calculated and paid on the benefits amount. If no benefit is calculated, hence S Limited would also not be paying any class 1A NIC on the benefits. However, at time of providing loan to Nuri, and what's the status of Nuri? Employee plus shareholder. S Limited being a closed company, S Limited would also be making a payment of 488 on the amount of 1500 at 32.5% to HMRC as per the rule discussed above. This one, the company implications at time of providing loan. Now, what will happen if the loan is written off? Writing off loan would be considered as dividend distribution for person, dividend distribution, and has no, first of all, let's think about the perspective of company. If company is providing any dividend, so that dividend would not be impacting any corporation tax liabilities. Writing off loan would be considered as dividend distribution and has no corporation tax implications for S Limited. However, however, as Nori is also employee of S Limited, so the amount of 1500 would be considered as gross cash earning for employee. And we know one thing that on gross cash earning, both the employer and employee pay class 1 NIC And in this part, we are talking about with respect to company, with respect to employer. So it means employer would be paying class 1 NIC on the gross cash earning paid to employee. Gross cash earnings on which amount? On which Nori and S Limited would be paying class 1 NIC on gross cash earnings. Accordingly, class 1 NIC, class 1 NIC for S Limited is 207. How this 207 is calculated? On the amount of 1500, on the gross cash earning of 1500, employer has to pay 13.8% of NIC. So resultingly 207 class 1 NIC is calculated. Furthermore, the same point over here, NIC is an allowable deduction for company perspective. So if this 207,000 is reducing the corporation profit, company profit by 207, resultingly company would be getting a reduction in the corporation tax liability by 39. Furthermore, therefore, concluding point, therefore, the total additional tax payable by S Limited in respect of alternative 2 is also fortunately the same amount, is also 168. How? If 207 is deducted from the company's profit, and due to this deduction 39 corporation tax liability is saved, so resultingly the overall tax, additional tax in respect of this alternative 2 is also calculated as 168. So it means nothing will differ if company provide a computer to Nori. It's giving you 168 as additional tax payable by S Limited. And however, in alternative 2, the resulting figure is also fortunately the same amount. Any questions, my dear? Yes, it's about, as you are asking, that it's about nothing will be changed if company provide a computer or give loan to Nori. Resultingly, the total cost for the company will remain same under both of the alternative. It's 168 in both scenarios. Okay, good to know about it. Let's talk about the second half of the question. Requirement: calculate chargeable gain for K Limited on the sale of first factory. And this calculation is for 3 marks. And under B2, explain with the supporting calculation the amount of chargeable gains in B1 which will remain liable to corporation tax even they are covered from the rollover relief. Notes: the following lease percentages should be used where necessary. If the lease term of 42 years, the relevant amount is 95.593 lease percentage, and if lease term is of 48 years, so the relevant lease percentage will be 99.289. Number 2, following indexation factors, as we discussed over here, index factor is calculated and normally also given in question. So you can see directly, instead of performing this calculation, we would be taking the indexation factors directly as also given in this question. The following indexation factor should be used where necessary. Indexation factor from August 12 to December 17 is 0.144, and from November 15 to December 17, that is 0.070. By the way, you can see that in both scenarios, both cases, the max date is 31st December 17. As I told you that this concept is not now followed in UK because any indexation allowance would be calculated on the assets purchased before 31st December 17. Okay, what's in this scenario? K Limited, disposal of factory 1. K Limited is UK trading company. K Limited was assigned a 48 years lease. As you can see from here, it's given for 48 and 42. It means company would be like using what's the differential given? It's 48 minus 42. Company may be used for this asset for 6 years, but we have to check whether the company use the asset for whole of these 6 years, or is there any period involved, that is when the asset was in non-business use. Let's say company rented out the asset, so that would be considered as a non-business use period. K Limited assigned a 48-year lease on factory 1 on 1st November 15. You can see this asset purchased on 1st November 15. So we would be taking a relevant percentage indexation factor from here from November till December 17, for which it paid a premium of 165,000. K Limited used the factory 1 in its trade until 30th April 21. Very important to understand, since when it has been rented out to tenants who are not connected with the company. And on 1st November 21, since acquisition from 1st November 15 till 1st November 21 till disposal time, you can see from 30th April 21 means from 1st May, the month of June, July, August, September, October. From the ownership period of 6 years, there are only 6 months when the company rented out, means the asset was not a business asset for the 6 months from total 6 years. 6 years multiplied with the total number of 12 months, so it means from 72 months the asset was not being used for 6 months in business purposes, and 66 months are the business use of the asset. On 1st November 21, K Limited sold the lease with 42 years remaining for 206,000. Okay. And requirement B1 is purely pertains to the chargeable gain calculation on the sale of first factory. So without reading further, I'm going to calculate the part B1 of the question, the chargeable gain on the disposal of first factory, and opening the spreadsheet in front of us. Very easy to calculate. Under B1, we are going to calculate for K Limited. And what we are going to calculate, mark a proper heading, gain on the sale of factory 1. Disposal proceed, I don't know the figure as it is given over here in scenario. Asset sold for 206,000. So disposal proceed is 206,000. Cost, company purchased this asset for a total of, very important to understand please, company purchased this asset for 165,000, but for 48 years, but after using 6 years company is disposing, so we have to use the lease percentages for 48 years and 42 years in the calculation. How to calculate the cost now is equal, bracket start, 165,000 total paid for acquiring divided by total period was 48 years, and the lease percentage for 48 years is 99.289. deducting it by 99.289 multiply with the remaining life. And according to remaining life, 42 years in fact, so the relevant lease percentage is also given. Okay, let me show you in bracket, is equal cost divided by its according to 48-year lease 99.289 multiplied with the remaining lease percentage of 96.593. So the cost of asset is calculated. How to show it appropriately? Use the custom and number, use 0. Okay, so it's giving you 165.20. As it's a negative figure, it's a cost, we have to show it as negative. So between bracket and is equal sign, please mark a negative sign. Resultingly, an index gain is calculated. From this unindex gain, that is equal sum bracket start the sum of these two, that is in fact again 45480. From this unindexed gain, we can now deduct indexation allowance. How to calculate this indexation allowance now? Another important aspect, from this value, from a total period of 48 years, we are disposing asset after 6 years when it had a remaining life of 42 years, but there is a period of 6 months involved. And we would be considering any relief according to that business and non-business use. But before that, how to perform calculation for indexation allowance? As you can see that unindexed gain is 45480 multiplied with the indexation factor. Now, which indexation factor we should use? We purchased asset in November 15 and November 15 till December 17. The relevant indexation factor is 0.070. So going to use the same multiplied by 0.070 and number format. Okay, so by the way, I have considered this selection wrongly. Indexation allowance is calculated on cost and cost is given as 165.20. So if we do it again, is equal the cost of the asset disposed multiplied with the indexation factor, that is 070. That's giving you 11236 indexation allowance. After deducting indexation allowance, chargeable gains are calculated, is equal sum bracket start from the unindexed gain less indexation allowance, that is 34244. But very important concept now, how much gains can qualify for any relief? Going to mark another heading, gains which can qualify for rollover relief. That should be calculated according to the business and non-business use. Further things are also required to check that whether the company is purchasing the other assets or not. But before that, let's say as it is mentioned that company is also acquiring factory 2 and also acquiring a warehouse. Both are business assets. Considering this fact, If company is also purchasing other assets, so we can claim, we can deduct ROR, but how much ROR we can claim is equal from this gain amount from company used this asset for owned this asset for 6 years, but from 6 years only 5.5 years being used in business from a total period of 6 years. So any rollover relief would also be considered as per the asset used in business and non-business purposes. When the asset was purchased, the total life was 48 years, and now when the asset is being sold, the remaining life is 42 years. It means company owned this asset for 6 years in fact, and from 6 years time period, company rented out, since when it rented out to tenants till disposal date, when it rented out on 30th April 21 and when it's being disposed of on 1st November 21. So it means it's a time period of 6 months. It means from total number of months, if 6 months are rented out, it means asset being used for 5.5 year in business activities from a total 6 years time period. So the max rollover relief can be claimed over here, that is 31390. That is 31390 can qualify. I'm not saying it will be qualified. Can qualify means further things to check according to this scenario, as company B is considering also buying the other assets, factory 296,000 and the warehouse at 78,000, but this warehouse will be used in its own trade to the extent of 70%, and remaining 30% will be used for rental purposes. So it means if we consider the value of 96,000 plus the 70% of 78,000, why we are doing this? Just to recheck that whether the company reinvested these proceeds or not. So factory 2 purchased for 138,000. It's also, we are also trying to cover the part B2 of the question because we are just having few minutes left. So over here we are also actually calculating the part B2, that is calc limited chargeable gains qualified for max ROR considering reinvestment in other business assets. Factory 2 purchased for 138,000. By the way, there is an other concept that the reinvestment should be in of qualifying reinvestment time period, that is in total 48 months. And how to check the 48 months time period? From before disposal, if any asset purchased within the last 12 months before disposal, and any asset which purchased within next 36 months after disposal. So total qualifying reinvestment time period is 48 months. And you can see that this building is sold on 1st November 15, sorry, on 1st November 21. K Limited sold factory 1 and purchased factory 2 on 1st May 21. In fact, before the disposal of factory 1, within the 12 months prior to the disposal of factory 1, factory 2 purchased, and another asset which purchased on 1st April 22, means within the next 36 months after the disposal of factory 1. So both assets are meeting the definition of the qualifying reinvestment time period. On this basis, we are considering the values of asset just to check whether how much ROR can be claimed. Warehouse purchased for, in fact, warehouse purchased for 78,000, but this 78,000 will be multiplied with the business use of the asset. So we can take an amount of 54,600 is equal, some bracket start over here, company reinvested in total reinvestment in other business assets after disposing factory 1, company reinvested an amount of 192,600. This 192,600 in fact is more than the, by the way, if we also do check from this value multiply by 5.5 divided by 6, we are just taking the amount which pertains to the business portion only. An asset sold for 206,000, but that asset was not purely a business asset. From that, basically we used for business purposes for 5.5 years from a total of 6 years ownership period. So it means an amount of 188 188,833 is calculated, and this amount is to be compared with the total reinvestment. As you can see, total reinvestment is more than this figure, but still a lower amount would be considered, can be for ROR purposes, because company cannot claim more than this figure, and this figure is calculated according to the business portion only. So it means company would only be getting the gains under ROR to the extent of 31390, even though company has have made reinvestment as compared to the actual amount company has reinvested of 192,600, but still the company would be claiming a lower amount of ROR for, it means a differential of, it means the differential of these two. What's the difference? The chargeable gain is this, and if these qualified for rollover relief, it means on the differential figure company would be paying capital gain tax. This amount is immediately chargeable under capital gains. So this is how you would be writing your answer in exam. By the way, due to shortage of time, we didn't read properly the acquisition of other two assets, but quickly I told you that there is a qualifying reinvestment time period concept as meeting in this scenario, and the other assets are business asset, of which one of the asset is not wholly used for business purposes. So we just considered the amount to the extent of the assets which being used for trading purposes. So now my dears, we done with the two questions. As we decided for today's agenda, we properly solve this question, as well as we just completed exam question 3 of March June 21 exam. So hopefully you enjoyed this session, and we actually tried to sum up all of the things, and the basic idea for these 4 sessions for ATX webinar is that to maximize, to enhance your soft skills by showing you that how you would be attempting question using spreadsheet and the word processor, and hopefully you guys learned multiple things, many things in these 4 sessions as conducted by Sir Kambar Raza and I. All these webinars are normally recorded on Vimeo, the ACCA channel. Don't worry, it would be shared on Vimeo's ACCA channel. You may follow from there. All right, my dears, it's time to wrap up this session, and I tried to cover all of the things with respect to each and every area, but still if you feel any query, you may contact at any time. I'm going to share my WhatsApp number, that is +92 is the country code, 3223787 is my WhatsApp number. You can directly ask in case of any queries. I repeat, +92 is the country code, 3223787 312. That's my WhatsApp number. You can contact. You may ask in case of any queries, and hopefully you are also added in the WhatsApp group. So we would be sharing all of these things, the webinar stuff and the other stuff in the WhatsApp group. So you may find the things from there. You are welcome, my brother, and thank you all for attending this session attentively. And it was quite good, as your responses, you are always responded quickly. I repeat, my number is +923223787312. It's also written on the screen. You may please can have from there. And before winding up, I'm wishing you very good luck for your exam. And it's my prayer that may God bless you all with the good marks in ATX, and you would be passing your ATX exam with flying colors. My prayers are always with you, my dears, for your future, inshallah. All right, and once again, good luck all. Do your best, give your best, and inshallah you would be getting good marks and you would be passing your ATS exam. Remember us in prayers, and do contact in case of any queries, anything. We are always here to like to accommodate you. We would. All right, guys, take care, stay blessed, and Allah Hafiz.